Welcome back to the show. Let's talk to Corvin Quadrilla. I never get that right, but there you go. Founder of CCFX. This is trading education. What I like about Corvin is he's a former hedge fund manager, so he's been there, seen it, done it, as they say. Morning to you, Corvin.
Good morning.
Right, we have a mind-boggling 14 slides. Without further ado, let's kick off. Letting winners run, horses for courses. What are you going to talk about today?
If we go to the next slide, you asked me to talk about the very favorite topic, and that's don't grab profits, let the winners run, and be very careful about your losses. And I want to give a complimentary view and say that's absolutely true, especially when you think about what it is that you're trying to capture. The market's paying you, and that's how you really should approach the market. You always have to ask yourself, what am I getting paid for? And once you understand the dynamics behind the thing you're extracting, you can make the money. And then it really comes down to, should I let them run or shouldn't I? There's never a black and white rule in the markets. And so that's really what this session is about today.
Okay, so
next slide. What do I mean by getting paid for properties of the market? So if you look at the different equity markets that you have, equities, FX, credit, commodities, they all have something that they pay you. So for instance, in equities, you've got momentum and growth stocks. In commodities, you have trends. In credit, you have differentials between high grade, so junk bonds, and investment grade bonds. And all these have a particular dynamic property. And so once you understand how that property manifests itself, you can place your bet. But as long as you don't understand what you're trying to milk, it's going to be very difficult for you to extract that value. So if we go to the next slide, what I'd like to talk about today, sort of make a recap of last session, which was the turtle trading system.
Yep.
And that's really all about momentum. And what does momentum mean? Well, once price moves, it really goes.
Yep.
And so how do you trade that? You have to capture it when it does move, so you have to let it run. If we go to the next slide, you'll see that the way the turtles traded it is by having a trailing stop on the back of their position. So they never try to anticipate when the market reverts. And that's one thing about trending markets is you never know when they stop. You do know that they do, but you want the market to tell you exactly when that happens. So here's an interesting question that you can say. If it's true that markets are trending and have momentum, do I really care that much about the entry? Or can I run a really nice test by just saying, let momentum pay me, and enter randomly into the markets? And that's exactly what the next slide is about. See, here's an interesting experiment. So this is a chart of euro dollar going back into 2004, 2005. And effectively what you do is you flip a coin. If it's heads, you buy. If it's tails, you sell.
right.
Once you buy, you effectively have a trailing stop on the back of it. So if you look at this chart, first time round you flipped tails, you went short. You had that trailing stop, the red line, which is just nothing more than the turtle 20-day lagging high. And obviously you got clonked out. You flipped the coin again. And this time you went long, and you have that trailing, the green line, the trailing stop to the downside. Obviously, markets continue in your favor all the way to the upside, and then it retraces, you get stopped out. But when you enter is really determined when you get stopped out. How you enter is determined by the coin. So the question is, how does this perform? So if we go to the next slide, very nice little back test on the back of euro dollar. You can see that going back to 1974 when the euro dollar futures came on board, or at that time the Deutsche Mark futures traded that way would have made you money. Now you could argue, well, this is a random entry. No, the whole point is that you're extracting a particular feature out of the market, and that's a lot of people when they develop systems go wrong. They're so focused on their indicators and this position, that timing, that they're forgetting, what am I getting paid for? So ask yourself, what are you getting paid for? Are you getting paid for trends? Are you getting paid for finding an undervalued stock? What is it that you're getting paid for? So in the back of that, you can next ask, well, if it's not just about holding positions, like I said before, in what situations would you not want to hold positions? And of course, what's the opposite of trend following? Mean reversion. So I've given you two examples here. On the left-hand side, you've got Canada versus Australia, which is these two ETF trackers. And if you do just a simple spread combination, you see that over the last 16 years, it's more or less been sideways.
Yep.
So that's a classic example of a mean reverting market. You sell high, you buy low, and you try to grab it because you know that that position is not going to last forever, just like in trend following. On the right-hand side, of course, is the VIX. We love the VIX. It's gone back to 2004 here on the chart. And again, it's mean reverting. It trades between certain bounds. It's not like a Yahoo stock that'll go to 100.
Yep.
And you never know when it's going to come down. So if we go to the next slide, sticking with the VIX, there's a very famous quote by Jim Rogers. We all love Jim Rogers. He's a phenomenal guy.
Rogers. Yep.
And he said, I don't buy options. Most of them expire worthless. So what does that mean for you as an investor? Well, it means that options tend to expire worthless because markets tend to be more range-bound than people anticipate. So by selling options, which are nothing more than a statement about the range the market will live in, you can grab the premium.
Yep.
Okay, so since we're FX people, let's focus on the FX markets. How can you do that there? Very simple strategy is to sell strangles. So strangling people, strangles effectively means selling or buying, or actually in this case, selling an out-of-the-money put, selling an out-of-the-money call. You capture the premium. You can do that on euro dollar with a very short maturity, 1 week maturity. You can do it on the exchange or with IG Index or other brokers. So if you do that on a regular basis and you backtest this strategy, you'll see that on the next slide, you get a very nice performance. So how does this differ from a trend following performance we saw previously from the euro dollar? Here you see very nice smooth upside, but when you get clonked to the downside. So that's a property of mean reversion. This is interesting about letting your winners run versus capturing profits. It depends on your psychology. Letting winners run means that you bleed money, but then you knock it out of the ballpark.
Yep.
On the other hand, if you pick up the pennies in front of the steamroller, you make money, but then you have to face that once in a while kind of gut-wrenching catastrophe. So that depends on the kind of person you are. To exemplify that, of course, on the next slide we have
the bird and the elephant.
Eat like a bird, poop like an elephant.
Yep.
And that's exactly what mean reversion tends to be about. But again, it boils down to the kind of psychology outlook you have in life. Some people like the steady income, and maybe once in a while they'll be knocked. Others can deal with the constant losses just to make it all back.
Well, I reiterate, anyone listening to this education piece should absolutely understand the implications of writing calls and puts, because your losses potentially are unlimited. And it's very, very important you don't get basically caught in a position like that, because it can take your house away, it can take your car away, it can take your bank account away. And I've seen it.
Yes, that's
absolutely seen it. So just make sure if you're writing options, you really understand what you're doing, because you do eat like a pigeon, you take a regular income in, and quite frankly, you crap like an elephant once a year or whatever it is, okay, and you give it all back. Well, you can give it all back and more. Right, let's move on to the next slide.
So when should you trade which version? And there's always a trader's of slave to volatility. Sometimes when markets really move, you have to follow the trend. There's no point in arguing against that. Otherwise, you're just going to go against the wall. And other times, the market's range bound. So the easiest way to do that is measure the volatility in the market. And so I've plotted here out our favorite currency, euro dollar on the weekly going back to 1986. And the ATR on the bottom. ATR is nothing more than the average true range. It measures the height and the low of the market. And as you can interestingly see, 2007 right up to 2010-12, great volatility in the market, moved, trend followers made a lot of money that time. May 2013, 2013 in general, with what's happening to Bernanke and QE, markets more or less went to a coma. Volatility, as you can see, more or less went off a cliff. And during that time, trend followers didn't make any money. It again picked up towards the end of 2014. Phenomenal end of year for trend followers right into the beginning of 2015. Since then, volatility has ebbed again. So be mindful. What are you getting paid for in the market? And then extract that. So to summarize it on the next slide, figure out what you're trading, figure out the dynamics, measure the volatility, and manage your trades accordingly.
You have a last slide, I believe. The call to action.
The call to action is sign up to my newsletter.
Yep.
There's more information like this over there. My focus, my background is systematic trading. I do believe in black and white rules when it comes to the markets. And that's where you can look at the data, look at the strategies, and find ways which give you long-term profitability.
Corvin, brilliant, brilliant stuff. Right, let's take a very quick break, and then we're going to come back to single stocks and major market review with Zach Meir, technical analyst for Zach's Trader Cafe. Thank you, Corvin, again, fascinating stuff.